In the world of investing, popularity often overshadows suitability. Just because an investment is widely followed or highly regarded doesn't mean that it's the right fit for your specific requirements. This is especially true when it comes to income-focused strategies, where the allure of dividend growth and premium names often influences the decision-making. Take the Schwab U.S. Dividend Equity ETF, or SCHD, for example. With over thousands of videos on YouTube dedicated to it, SCHD is a massively popular ETF. It promises income growth, offering investors the prospect of rising annual dividend payments. SCHD tracks the Dow Jones U.S. Dividend 100 Index, with the bulk of its holdings being popular names with consistent payment raises to shareholders. On the surface, this is incredibly appealing. After all, who wouldn't want to invest in companies with lower payout ratios, steady revenue growth, and a history of consistent dividend raises? However, dividend growth is not a guarantee of safety. Companies that have raised dividends for decades can still falter, and even the most reliable payers can cut their dividends when faced with financial distress. Consider the following examples of companies that, just a few years ago, no one would have expected to cut or eliminate their dividends. Walgreens. A former dividend aristocrat, Walgreens cut its dividend by 48% in 2024, breaking a streak of uninterrupted payouts that dated back to 1932. Boeing, once a dividend contender with a history of uninterrupted payments since 1989, Boeing eliminated its dividend entirely in 2020 amid the fallout from the 737 MAX crisis. Leggett & Platt. This company slashed its dividend by 89% in early 2024. 3M. Following a significant spinoff, 3M cut its dividend by nearly 54%. Intel. In 2023, Intel reduced its dividend by 66%. VF Corporation. This company slashed its dividend twice in 2023, resulting in a cumulative reduction of 82%. With a turnover rate of 28.6%, SCHD is relatively active. But it doesn't go far enough for my needs. You see, I expect diversified funds to actively work in the markets, generating meaningful income beyond just passively delivering what they collect. SCHD offers little difference from holding its underlying stocks directly. For true income generation, I look for funds that do more than just pass through dividends. At Dimple Developments, we target a 9% overall yield from the portfolio and recommend reinvesting at least 25% of the income back into the portfolio. This results in a 2% compound annual growth rate for your income, even if you were to assume the portfolio yield doesn't increase. Over the past 12 years, SCHD has delivered a 6% dividend CAGR and currently sports a 3.7% yield. If we were to compare the annual income from a $10,000 investment in both scenarios and assume a 25% income reinvestment, it will take 25 years for SCHD's dividend growth approach to generate annual income in excess of our approach. Sure, you can sell shares to supplement your income anytime, but remember that doing so will shrink subsequent dividend payouts. And this is not an approach we pursue. I'm not saying that SCHD is a bad investment for everyone. However, if passive income is your primary goal, there are clearly better choices. Let us discuss our top picks to put our sustainable high-yield strategy in action. Pick number 1. BST Yield 8.2%. Technology is a cornerstone of the American economy, accounting for over 10% of U.S. GDP and employing millions across various industries. In 2023, the tech sector contributed nearly $2 trillion to the country's overall GDP. The sector's influence continues to expand as advancements in artificial intelligence, cloud computing, and digital infrastructure become even more embedded in our daily lives. With massive investments pouring into AI, the industry is entering a new chapter of growth, offering long-term promise despite the frothy valuations of certain high-profile names. However, identifying long-term winners in emerging technologies is no easy task. History is filled with examples of once dominant players, BlackBerry, Nokia, and MySpace losing relevance despite early success. Rather than trying to pick the next tech giant, we prefer a diversified approach that captures the sector's growth while ensuring our pockets are filled with regular income as the sector continues to expand its dominance in the markets. BlackRock Science and Technology Trust, or BST, is a closed-end fund that primarily focuses on technology stocks, with a portfolio of 110 holdings. However, the fund's top 10 positions represent about 50% of the invested assets, with a large allocation to the Magnificent Seven stocks. This allocation can be scary, as we increasingly hear about the markets being overvalued. But the fund manager pursues active strategies, including covered calls to protect the downside of its investments. Over the past 10 years, BST has delivered a solid performance, handsomely beating the S&P 500 and SCHD market indices while placing steady monthly income in the pockets of shareholders. Notably, BST has delivered growing distributions to shareholders since its inception in 2014, with at least 3 instances of massive special distributions. While SCHD has steadily grown its distribution to shareholders, it is yet to match the might of BST and will likely not do so. During the first half of 2024, as of June 30th, BST reported distributing $51.9 million to shareholders, with all of the funds sourced from net investment income and realized capital gains. The CEF reported $202 million in net change in unrealized appreciation, demonstrating a forward-looking distribution coverage for about 2 years. We expect this sum to be higher, since big tech has rallied significantly since the elections. BST does not utilize leverage in its investment strategy. Today, the CEF trades at a 4% discount to NAV, presenting a rare means to buy into big tech at a discount. Pick number 2, RVT, yield 8.7%. The stock market action on Thursday shows the effects of weak earnings, impatient investors with unreasonable expectations, and analyst downgrades in a frothy market. Trading stocks during the earnings season can be unnerving, and investors can potentially lose large sums of money very quickly. You may think that it is only applicable to the less established companies, perhaps those that are yet to demonstrate consistent profitability. However, even the mighty Walmart experienced a sell-off following spectacular results, coupled with the issuance of weak guidance for 2025. Investing for consistent capital gains requires a close focus on meeting, or rather exceeding expectations in quarterly results and guidance. Moreover, the U.S. markets are highly liquid, and the dominance of algorithmic trading can exacerbate volatility, triggering rapid price swings that often leave retail investors at a disadvantage. Large and mega-cap stocks are particularly trading at historically high valuations, demonstrating that there is little room for error, and any disappointment in earnings, outlook, or guidance can leave shareholders with heavy bags. It is important to seek a margin of safety in such markets, and we find this in the small-cap value segment. We let the experts do the work while we sit back and collect a healthy income stream. Royce Small-Cap Trust, RVT, formerly known as Royce Value Trust, is a closed-end fund with over 38 years of solid market outperformance. However, market outperformance isn't the only reason for considering RVT. After all, past performance isn't indicative of future results. Born in 1986, RVT employs a time-tested strategy of actively managing a broad portfolio of small-cap value stocks. Over the decades, the closed-end fund has navigated high inflation, wars, geopolitical conflicts, recessions, valuation bubbles, and even a global pandemic, constantly adapting to shifting market conditions. The fund's top 10 positions represent only around 11% of the invested assets and are large companies that you may have never heard of. RVT is built with 486 holdings and considers the Russell 2000 index as its benchmark. The CEF has a managed distribution policy where its quarterly dividends are directly linked to its NAV. This explains the variation in quarterly distributions. What does this mean to you? The fund pays quarterly distributions at an annual rate of 7% of the average of the prior four-quarter end NAV, with the fourth quarter being the greater of these annualized rates, or the distribution required by IRS regulations. RVT Annual Report. It isn't just your income that is tied to the CEF's NAV. Management fees are too. Management fees are performance-based and are increased or decreased if RVT outperforms or underperforms the Russell 2000. The performance is measured every month on a rolling 36-month basis against the index's performance and is used to determine the monthly management fee with a high-end and low-end threshold. Essentially, the portfolio manager eats their own cooking, and we love this arrangement. It motivates management to maximize our income to earn their bonuses. RVT has beaten its benchmark index in 4 out of the past 5 years. Despite its variable distribution policy, RVT has delivered outstanding income over the past decade compared to SCHD, even through the poor market performance in 2016 and 2019, the COVID-19 market crash, and the bear market of 2022 due to higher borrowing costs, which particularly hurt smaller companies more significantly. RVT has notably underperformed in terms of total returns over the past 5 years due to the slower recovery of smaller companies from the global pandemic and their struggles with higher inflation and rising borrowing costs. However, looking ahead, amidst the backdrop of a richly valued market, RVT presents opportunities in sectors offering a strong margin of safety through their discounted valuations. We can already see the benefits of this setup in the form of RVT's strong total returns over the past 18 months, beating SCHD due to the latter's increased focus on big-name dividend payers that continue to trade at fair to rich valuations. RVT sources its distribution mostly from capital gains from its active management strategy. The CEF reported $102 million in realized gains and $110 million in unrealized gains on investments during the 9 months of 2024, as of September 30th, 2024, while distributing $94 million to shareholders during this period. Today, RVT is available at an 8% discount to NAV, making it a bargain in an already discounted sector. You get a margin of safety and reliable income through whatever the markets face ahead. Experts often argue that dividends are the same as selling shares, and that CFFs involve paying fund managers to do the selling for us. I disagree with the notion of quantifying active management into something so rudimentary. Take a look at our discussed picks, BST and RVT. Both have a history of NAV preservation and growth over the longer term, demonstrating that they are able to distribute large income while keeping the original investment intact sustainably. Relying solely on selling shares to fund your lifestyle leads to a steady decline of income and eventually a depleted portfolio. It also ties your well-being directly to market performance, creating unnecessary stress and uncertainty during retirement. A well-designed income strategy, on the other hand, ensures your assets continue working for you, providing reliable cash flow without eroding your principal. At Dimple Developments, we believe in building portfolios that not only support your dividend income needs. By focusing on sustainable income and active management, we help you achieve financial security that lasts. This is the essence of our investing approach, letting your assets work for you today, tomorrow, forever.